Abby, so good to see you. Today, we're going to talk through 4 ways to improve investment performance. This does not mean taking on more risk or chasing the latest trend. Often, it's about getting the fundamentals right. So, let's walk through 4 simple ways that investors can improve their results without making things more complicated.
Mhm.
Number one, automate and then get out of the way. Automate contributions, your investments, how often you rebalance. What else, and how does this help?
Automation is one of the simplest things that people can change that makes the most difference.
Yeah.
And this is true in a lot of areas of our life, and especially true with finances. So, the reason 401ks have taken off so much and work so well as a savings and investment vehicle is because largely they're automated. A
Yeah.
lot of times when you're hired, you are automatically enrolled in a 401k. You can choose a percentage, of course, but there's usually a standard or a minimum, and the ball just starts rolling without you having to lift a finger. That money is in your 401k, out of sight, out of mind in this instance is a good thing. As long as you're checking the investments, making sure that you're invested in the right thing. That's a mistake that people make is, yes, they're investing in the 401k, but it's going into, like a money market fund. So
Mm.
even if it's automated, maybe set up a quarterly date on your calendar to at least check on things so it's not too far out of sight, out of mind. But with all of your savings, with all of your investments, if you're a business owner and you have your own retirement account, whether it's a SEP or a simple or just a traditional or a Roth IRA, that needs to be set up automatically as well so that you can have the same structure as, just a regular employee at a company because it
Right.
works really, really well.
Right.
If you have to go in every month and decide how much you're going to invest, decide what you're going to invest in, that takes a lot of time, that takes a lot of mental energy. And especially if you're in the accumulation phase, you have maybe kids that have activities, we're all so busy. It's just not going to happen on a monthly basis. So you miss out on a lot of opportunities there. This is the same thing goes for if you're paying off debt. If you're trying to pay off debt or increase your emergency fund, your cash reserves, all of this can be automated. An advisor can really help with this, but you can also just do this on your own.
Mhm.
But whatever your savings and investments are, decide at the beginning of the year what you want to contribute to those accounts and set it up automatic. If you need to adjust it mid-year, you can certainly do that, but you don't need to make those decisions every month.
Right. And set it up like any other bill. Good point. Number two, consolidate. If you have old retirement accounts floating around, managing your money becomes even harder. And of course, getting a look at your whole financial picture becomes even more difficult. This is an easy and often overlooked step.
Yes, so consolidation is huge. So a lot of times people have the same type of account, but they're spread all over the place. I've met with people that really want to get a better handle on their finances. And, of course, they come in for the discovery meeting. We want to go over everything. And we'll be sitting there talking about their different accounts. And then an account will pop into their mind. They'll be like, wait a second, I think I might have another IRA or 401k at, a job that I left 20 years ago. And it literally is not even on their radar. And this happens more often than not. So as people are more frequently changing jobs, this is becoming more and more important
Right.
because most people don't stay at the same job for 30 or 40 years. So you can consolidate most of those accounts. You can still diversify over the companies you're invested in, the investments that you have, the funds you're in. So it's not putting all your eggs in one basket. It's just making things simpler on you. And also, if you do need to have multiple companies for whatever reason, there are software and apps available that you can load all of your information. And I use one that makes my life a lot easier. So I have all of my investment accounts in there, my retirement accounts, my emergency fund, everything is in one place. So I can truly go in, on a whatever basis I choose to, on a monthly basis or quarterly, and see the full picture. So I know where I am, and nothing is falling through the cracks.
hmm Right. Despite the fact that often those forgotten 401ks have incredibly high fees that a lot of people aren't taking into account either. So many
That's right.
benefits with that one. Number three, define your time horizon before investing. This can help guide your decisions when it comes to buying, holding, or selling an asset.
Yeah, so time horizon is one of the aspects of what we call a risk profile. And so when we work with clients, we want to define their risk profile. And this really is composed of a couple of different things. So your risk tolerance is number one. So that's how you emotionally feel about the ups and downs of your investments. And then the other part of that is the time horizon that you have. So how long do you have before you need this money? So when I work with someone that is, 10, 15, 20 years from retirement or 20 years from whatever goal they have, we're investing that money very differently than if I'm working with a client who is saving and investing to open a business in 2 years. And a lot of people get in trouble when they try and speed up the time horizon. So if you have a goal in a couple of years, that money really should be, fairly conservative, because what you don't want to happen is right on the cusp of you needing it, whether this is opening a business or paying for your child's college or retirement, the market to take a dip, and all of that time that you've spent saving for that, kind of goes out the window. So this has to be defined. Each bucket of your money needs to have a specific role. So there can be short-term, more short-term buckets, mid-term buckets, and then longer-term buckets, which this is a great example of that, or illustration of that, the bucket strategy. So your safe money is going to be in cash and cash alternatives. Just make sure that they're being managed so that you're not losing money, or you don't have more lazy money than is necessary. And then you have either the near or the midterm bucket or the income bucket if you're in retirement. So this is going to be the accounts that are paying you, replacing your paycheck every month. And then we have the longer term bucket, which is the growth bucket. And those are going to be the more aggressive, more growth oriented investments. So stocks, mutual funds that have various equities, and ETFs as well.
Mm-hmm. All right, number 4. I feel like this is easier said than done, though, Abby. Save a little bit more money every year. And this, you brought up a really good visual for us to kind of help understand how this can make a huge difference. So let me just pull that up. And this example shows, this is assuming $80,000 starting household income increasing at 3% per year. What are we looking at?
So this is an example of not only the allocation that's chosen and how that makes a difference, but also the savings rate and how that makes a difference. So this is over a 25-year period. And like you said, starting at $80,000 starting household income. So we look at the top row, that's going to be 100% in stocks. Now, that does, in this time period, have the highest rate of return, but a lot of times people don't have the risk tolerance,
Right.
Or the risk profile to be 100% in stocks. So we'll look at a couple of other allocations as well, like 80-20, 60-40, and 40-60. The more you save, and like you said, this is easier said than done. Obviously, you have to make some sacrifices to save more, whether that is cutting back on your lifestyle or taking on more responsibility at work to increase your income. This does come with sacrifices, but the payoff at the end is so worth it. And what we try and do is coach our clients on, let's make meaningful small changes over time that build to be really large changes in the future. So even a 1 or a 2% increase every year can make a huge difference over time. And what that chart shows is, yes, if you're 100% in stocks, you're going and you save, 20%, you're going to have the most amount of money. But if you don't have the risk tolerance for that and you want to be 80-20, you can still save, instead of saving 10%, you can save 15% and get to almost the same place as having 100% in stock. So there are things that we can control based on your risk profile and how much you can save to get you to reach your goals. You just have to have a good handle on your budget, understand your risk tolerance, and pick the right mix for you. And that's going to be different for everybody.
Right. Well, that's one of the things that I do automate on January 1. Those retirement account contribution limits go up. I put it on, I put my blinders on. And this, I'm glad that we were able to talk again about the fundamentals, Abby. But you brought up some really good points when we were talking offline about people who are working with financial advisors who might be not realizing some of the costs that they are paying. Explain the example you were just talking through with me.
Yeah, so I just met with a couple recently who have worked with a couple of different advisors. They're well into retirement. They retired early in their mid 50s,
That's great.
and they're still trying to find the right fit. And luckily, they have. I believe we're going to be a great fit for them. But we talked to them about something that none of the advisors they've talked to, neither of the advisors that they worked with, had ever brought up to them before. And it's all about creating the most efficient portfolio possible with the least amount of risk you need to take. Everybody needs to take a certain amount of risk. That's there's no getting around that. But if you can make your portfolio more efficient without taking on more risk, that's really the key, especially in retirement. And so what we looked at was not just the investments that they had. Yes, we do an analysis on that and a stress test and all of those sort of things. But we also looked at the underlying costs that they weren't seeing on their statement every month. They knew what they were paying their advisor, but they didn't understand what we call their total all-in costs. So we helped them understand that. We kind of pulled back the curtain and also helped them understand that we can utilize very similar investments. We don't have to change, necessarily what indexes you're invested in or what sectors you're invested in, but we can do this in a more cost smart way. And then also what we talked about is something called tax drag. So in this situation, they had a very large joint account, which was non-qualified. So it doesn't have that IRA or 401k shield. So a lot of the income and dividends and other income producing events were flowing to their tax return every day. Now, these are fairly high net worth individuals, even in retirement. So they were getting surprise tax bills literally every single year.
Right.
So what we talked to them about and what we can quantify with our process is what's the tax drag on your investments and how can we reduce that so that you're first of all, you're not getting surprised every year with a big tax bill. And then also your overall performance is not being dragged down by that tax drag every year. So those are two things, just two of the things that we look at when we do an overall analysis on somebody's portfolio.
Right. And then a reminder to everybody watching, if your financial advisor is just talking about your investments, you need a new advisor. You need someone who's talking about taxes and all of the other checks we cut yearly or monthly. So Abby, if somebody would like to talk to you more about this, what's the best way to reach you?
You can always give us a call at 678-442-0255. You can also visit us at theretirementfamily.com. We have a lot of great resources on there. We have a lot of videos on different topics. We have a lot of articles and a blog. And you can also send us a message. It comes straight to us. Let us know what's on your mind, what you would like to talk to one of our advisors about. And one of our staff will reach out to you and set up a 15-minute introductory call so we can explore that together more.
Great. Abby, thank you.
Thank you, Erin.